Welcome to our High Rock monthly video for January. Happy New Year to everybody. With me today on the call is Paul Tepsich, our founder and the portfolio manager. And of course, we have Diane Leckie, our senior client service rep and compliance manager, with us today as well. So we can talk about a few administrative situations. Quickly, we'll just go through December. Not a good month, which pretty much summed up most of the year of 2022. You can look here and see that financial markets were all in the negative except for the gold, silver, commodity situation. And you know, we've followed and tracked this over the course of the year, but it again proved wise to have a balanced mandate as opposed to maybe something a little bit more aggressive through the course of 2022, although even balanced mandates struggled. Paul, I don't know if you want to add anything to this, but it was a pretty difficult year for financial markets all in.
No, it was brutal. I mean, I think it was the worst year for U.S. Treasury bonds, government bonds, in 70 odd years. One of the worst in stocks, and I think the worst ever for U.S. balanced mandates, stocks and bonds put together in a portfolio. So I think two things on this chart. I would say number one, gold and silver, which we have had some direct exposure to, and I would note we own physical gold and silver. We do not own paper gold and silver, which quite frankly is just the credit risk of the bank that may hold the paper gold and silver. So that really just kind of ramped up over November, December, and became positive. But as you can see by the chart, through the bulk of the summer, spring, summer, and early fall was negative. So we maintained our weight in there, and for newer clients, we made sure they added to their weight. So that worked out pretty well. And the Canadian equity market obviously outperformed some balanced mandates, largely because of the large exposure to fossil fuel risk, i.e. energy. And the third thing I would note is, I won't talk about individual performance for High Rock balanced mandate clients, but I think everyone will find that their portfolios and performance was much better than, as you see on this chart, circled in black, the balanced mandate. So we can go into some of why we outperformed that balanced mandate, or a balanced benchmark, if you will, as we go through the video, Scott.
Sure. And one thing we should note is that when we take into consideration the distributions of income from dividends or interest payments in the benchmark iShares core balanced ETF, it actually adds some value of a couple percent. So the total return for the year on that benchmark was down just around 11%. So again, this you can use as a comparison when you get your portfolio review, which we'll be sending out later this month, which will show you your year performance. And of course, we are wide open to having conversations around each client's individual portfolios, their relative performance, and specifically what we look for going forward, and how, with a year like this, are we going to continue to drive towards your specific goals, because we're always managing with the long term in mind as well. Paul, just talk briefly about your special mandates, because I think you should be congratulated on finding probably one of the only positive financial markets with which to invest this year, and I think you should take some accolades for that.
Thanks, Scott. Yeah, our high yield mandates did very well. just again, I won't speak specifically on performance, but I will tell you they were positive, more than 1 or 2%, but less than 10. And the U.S. high yield ETF, the largest ETF, HYG, was down about almost 15% year to date on a total return basis. So we had significant outperformance there, and a lot of that was, there were a lot of bonds in those portfolios. They're all identical on both bonds and percentage weights on individual bonds. A lot of the bonds were down year to date, both in price and total return, i.e. Interest income coming into the portfolio. But we had a very large weight in the energy sector for the past 2 years. So that really helped us out a ton. And although some of these underlying stocks in these energy companies have been very volatile, the bonds have not. And they continue to clip out fantastic, in some cases, very substantial yield for the portfolios, but the price stability is either increasing or remaining flat. So low volatility and very solid return. So we're thrilled with that. And I would just say, if anyone wants to know more, they're going to have to call me directly.
And also, clients should know well that in our, and if they have exposure, as most do in their balanced portfolios, they have some exposure to the tactical model. And Paul, some of these high yield mandate assets are held also in the tactical model. So our balanced mandate clients do have some exposure to some of these, and it's certainly part of the reason why their portfolios have been performing somewhat better than the benchmark.
Yeah, absolutely. I can talk a bit more about that when we go through each model.
Yeah. And of course, we're always talking about the long term. We think we always have to manage everybody's expectations. We want to be constantly monitoring and updating your goals, of course, and we'll talk about making sure we have regular reviews. There's a lot of clients who we asked to have reviews who haven't responded, so we want to get on with those as soon as we possibly can, and talk about the long term and what a year like last year means going forward. And we know, as we started to discuss this last year, and we popped this chart up each month, but it's to remind and remind clients that what occurred in markets between 2010 and 2020 is not going to be necessarily the rule as we look to the future. So we've got to start to manage expectations going forward. Paul, this is your chart.
Oh yeah, I used this chart in a blog I wrote, I think in mid-December. But I think what we want to show and talk a little bit about here is how we feel like inflation has peaked, and inflation being represented both by the sort of blue line and the light green line. That's US CPI. Actually, it's supposed to be orange, but it looks green. So the blue line and the orange-green line are US CPI and PPI respectively. You can see how they've obviously peaked around the red circle. And the red line, interestingly, is money supply, which is represented most commonly by M2 as a measurement. And you can see how that is the rate of growth on a percentage basis, year-over-year rate of growth. And you can see that we are growing just over 1 or 2% on money supply growth. And there are two things I would say about that. First of all, we're growing less than we did pre-COVID, 2017, 2018, as you can see by the chart. We need money supply growth for the economy. So that's not a great thing certainly for equities moving forward. But what is good for the markets is that inflation is coming off. And as inflation comes off and the Federal Reserve, the Bank of Canada, other central banks around the world see this, they will ease up on monetary tightening, i.e. higher interest rates. So we think the Fed or these central banks in general, are maybe not done. There may be one more hike coming here in early February, but we think they're pretty much done. And to express that view, actually, you know what? I'll leave it there, Scott, and we'll go through. We'll talk about how we express that view in the models.
Yeah, sure. And just to follow on that, the markets have now started to watch very closely what happens with the data that's coming, and we're going to see U.S. CPI data on January the 12th. The expectation at the moment is to see a number in the vicinity of 6.7%, and that's total CPI. And then in Canada, we'll see the number for December on January 17th, and the expectation there is for a number closer to 6.4% on the total CPI. So just to give everybody an idea of what's coming and how we're monitoring these short-term events, and of course what the central banks are going to do. At the moment, the Bank of Canada is scheduled to meet next on January 25th to determine what they're going to do. At the moment, it's expected that we'll see a 0.25% increase, and then shortly thereafter, the following week, the Federal Reserve, the U.S. Federal Reserve (FOMC) will announce their next rate move, and it's expected to be a 0.25% increase as well. So, as Paul said, we still think central banks are going to raise at least one more time, and then perhaps have a look and see how that has, and all of the increases are impacting the economy. And our view certainly is that this should definitely be slowing the economy, and as can happen, because it's not an exact science by any stretch, is that the economy or the central banks can push economies a little harder than necessary and closer to recession. So we'll be keeping an eye on those things, and of course how they impact and how that impacts financial markets. So quickly, let's talk about the global equity strategy. We still are a little bit overweight cash. We used the down markets of 2022 to be adding global equities. So that's worked out reasonably well. We may get another opportunity. We'll keep an eye on that to see what happens next. We still think, relative to recessionary times, that the price to earnings ratios are historically high, and we could see those come down a little bit. That could give us a little bit more value with which to be buying more equity positions into client portfolios. So we're being patient with the global equity model at this particular point in time.
Yeah, the tactical model. I'm just going to highlight a couple of things here, more over the past month or so. One little sleepy position we haven't really talked much about, Scott, is Source Energy Bond, which we bought this back in August and I think again in October. So we bought this bond at $35 average, roughly, which we did not buy a big weight for people. It was a very measured weight. It is a distressed bond at 35% of par, $35. It was yielding around 35% cash yield. Now we've held that bond. Sorry, we bought it in summer and fall of 2021. So we've held that bond coming on a year and a half at 35% cash yield. So very substantial. Now the bond is also improved as of last week and today, up towards 73 bid. So we've more than doubled our money on that position on the price basis, and we picked up 35% plus for a year and a half. So it's actually coming around. I'm pretty happy with that. And of course, when they go up that much and that much yield, you wish you had more. But we do want to measure our risk. Another one I'll talk very quickly about is Sherritt. We do have a position in the stock. We are, as of today, trading around our cost. Not that that matters. We should never. I had a former boss who was probably the best trader in the world I've ever known or heard about, and he always said, "Don't trade from cost. You know, where you bought something doesn't matter. Where market doesn't care where you bought something." Nonetheless, it feels good to be back trading near our cash cost. I think this stock is it's one of our larger single positions on the equity side of the tactical strategy, but I think it's our most opportunistic or the one with the most torque. The stock's trading around 60 cents right now. I quite frankly think over the next year to 2 years, it's going to be a $5 plus stock. Just given the valuation it's trading at, I've only seen one company trading this cheap in my entire career, and it was back in probably 2003, 4. It was Colnet, which owns Sprint Canada, and Rogers ended up buying them. I think this is going to be a great position. We also actually added to a Sherritt bond. I guess that was back in the end of November, and it's trading with a very substantial yield as well. And the only other thing, and that's traded up, you know, we bought it at 55.5 cents. The company's trying to buy it at 55 cents on the dollar. We bought it at 55.5 cents on the dollar. And it's currently trading, you know, with a yield of 16%. We did not buy very much. We couldn't. Unfortunately, liquidity is tough. And the one thing I will say about Sherritt, and again, anyone can call me if they want more information, but we are effectively limited and we cannot buy any more Sherritt bonds or stock. So we will not be trading this position around at all. We're in it for the long haul on both the stock and the bonds. So those are just two highlights from the tactical. But again, the third thing I would say on the tactical, Scott, is how you mentioned sort of outperformance versus other balanced mandates. Has been some of these energy bonds that we've held in the tactical model that have substantial yield or income coming into the portfolio, and they've either improved in price or maintained a very static price, which we like to see. So they've really added value along with Baytex Energy, which is the one energy stock we've held for the long haul. And that stock actually sold off pretty significantly over the past 6 or 8 weeks, just with the price of oil getting hit. I still like fossil fuel energy risk, and I like the positions we have on, so we will maintain those. I think that's it for the tactical.
Excellent, excellent, great work on that.
Fixed income. Well, the chart we showed with money supply dropping and inflation likely to follow. The one thing I would add here is people watching, listening to this video may say, well, if, you know, you think the central banks are still going to raise rates 1 or 2 more times, why are you bullish, or why do you think interest rates have peaked, and why are you adding to that type of interest rate risk? Well, the reason being is that central banks only affect the overnight rate. They don't go out and affect bonds out the curve in the 3-year, 5-year, 10-year, 30-year part of the bond curve. So those are extremely large and institutionally traded. The government bond markets, like the U.S. Treasury bond market, is mammoth. It dwarfs the equity markets by a long shot. It's all institutionally traded, and they are always looking forward. So bond yields have peaked, in my opinion anyway. And to express that view, what we've done in the fixed income market, and I mentioned this in the last monthly call, but we've been spending our time swapping out of our preferred share rate resets, and they benefit when interest rates go higher because they reset. Most of the ones we own anyway reset every 5 years. So as interest rates go higher, they benefit. We've been swapping out of those and buying fixed rate prefs. Now, this is taking some time because these preferred shares are somewhat illiquid and lumpy at times. But we're still on top of that trade. to transition from rate resets to express our view in peak inflation and rates into fixed rate preferreds. The other thing we did do is last month we added to our U.S. government bond position in both the 7-year and the 30-year part of the curve. And you may recall from previous calls that we've been underweight interest rate risk for 2 years, and so that's part of where our cash position is meant to be spent. So we're pretty well where we need to be now in government bonds. The one place we need to continue to work towards is these preferred shares. So we've got a little bit more to do that way, but we're quite frankly getting there. I think that's about it, Scott.
Okay, great work. Thank you so much. And of course, we and I talk about this every month, but it's really important that we do continue to have dialogue with our clients and have conversations around where they are with respect to their goals, and what if anything should necessarily be done with the investing strategy, especially perhaps given that last year was not a great year for balanced portfolios. So if there are strategic adjustments that need to be made, if we need to adjust allocations to the models, these are all important conversations that we need to have. So when we do ask you to sign up for a review, it is for your benefit, and we benefit too, because that keeps the regulators on side with us as well, because we do have to have at least an annual review with all our clients to keep the regulators happy. And of course, we have to update documentation. And on that note, Diane, I'm just going to turn it over to you if you have anything you'd like to throw in here.
Okay, thank you, Scott. Actually, I was just going to bring up, there's a couple of reminders and updates. We have tax season is approaching, and just wanted to remind people that there are some EFT and fund adjustments that are processed mid to late March, which delays the gain loss statements until the beginning of April to capture those adjustments. And also to let the online users can find their tax info under tax receipts and performance fees. I know sometimes people are looking for the fees and are unsure where they are. That's under the performance fee tab. We will provide a tax slip distribution and online posting schedule once and updates as they become available to us. And under the updates, I just wanted to let you know that the T5008s, which are slips that reflect trading within the year, the slips this year are going to contain both the cost and the proceeds for transactions closed within the tax year. Also, just the last two reminders really are that the RSP contribution deadline is March 1st, and that the TFSA contribution limit for 2023 is $6,500. I just wanted to remind people that if they go onto the CRA site under my account and they're looking for their tax information, if you're looking at your RRSP contribution room and your TFSA numbers, just be sure that those are including the 2022. Sometimes those are delayed, and we don't want you to be caught up in an over-contribution issue. Anyway, that's it for that information, and there will be some documentation updates being distributed this year, but we will talk about that as we get closer to that situation. Thank you.
And just a reminder to everybody that if you have any questions about any of this, we want to hear from you. We want you to feel comfortable getting in touch with us and talking to us about your specific situations. We can talk broadly on these calls, on these videos, but we can't talk very specifically. And in a lot of cases, everybody's got very tailored circumstances. So we want to make sure that you, if you need to talk to us, and we want to talk to you, to please contact us directly with any questions, anything at all that you need help with. And on that note, on behalf of Paul and Diane, I will once again wish you all a very happy and prosperous and healthy 2023. And we'll be back in a month's time with our next version of the High Rock monthly video. And until then, you all take care.